Before we deconstruct the exact mathematical blueprint to permanently exit the global labor market, I have exactly 3 critical questions for you to answer in the comments below. Number 1, are you currently depositing your first corporate salary into a traditional saving account, actively funding your own financial funeral? Number 2, do you view your entry-level paycheck as a personal spending money, or do you treat it as a raw seed capital for aggressive asymmetrical venture acquisition? Number 3, have you studied the 2026 pension and regulatory reforms that allow retail investors to bypass the legacy banking and directly fund high-yield neuromorphic chip startups? Let us know your answers. If you are new to the channel, here is my intro. I am Dr. HR. I approach the global labor and capital market not with an emotional, comforting advice, but as a structural algorithmic systems. I hold a PhD in Human Resources, a Master's from prestigious Tata Institute of Social Sciences, Thesis in Mumbai, and a Bachelor's in Computer Engineering. Operating on the ground here in Dubai since 2010, consulting for Tier 1 corporate entities, sovereign wealth funds, and apex tech founders across the Middle East and Indian subcontinent, I have monitored exactly how generational wealth is synthesized. The market does not reward you for how long you work. It rewards you for how aggressively you acquire the sovereign leverage. Stop putting your first paycheck into a saving account. You are literally funding your own financial funeral. Thanks to the sweeping 2026 pension reforms, you are now entirely bypass the traditional banking algorithms and funnel your entry-level salary directly into private equity and neuromorphic chip startups. This is not a theory. This is exactly how you retire at 30. The 2026 wealth gap is closing violently, fast for those who know exactly where to look. By treating your first salary as a venture capital rather than a standard spending money, you can front-load aggressively asset acquisition during this unique, highly lucrative regulatory window. We are actively engineering a permanent workforce exit before your 31st birthday. Imagine never having to clock into a corporate grid again by the time you turn 30. While your naive peers are focused on gradual mathematical obsolete 401k growth, mutual funds, the smartest 2026 freshers are leveraging the high-yield neuromorphic tech investment to secure a decade of brutal, unshakable compound interest. It is time to turn your entry-level income into an absolute legacy. Before I completely dismantle the illusion of traditional financial planning, expose the exact thermodynamic physics of a neuromorphic chip market, and give you the precise architectural blueprint to convert your first salary into a permanent equity shield, hit the subscribe button and press the notification bell. I post daily videos showing you exactly how to navigate the global labor and capital market using cold, hard engineering logic. You do not want to miss these execution protocols. Stop working for the capital. Force the capital to work for you. Grab a notebook. It is time to architect your exit. Phase 1. The saving account funeral, the provocative contrarian. We must first diagnose the exact debilitating macroeconomic trap that 99% of fresh graduates walk blindly into on their first day of corporate employment. You spend 4 years in an engineering or business academy. You graduate, you secure a Tier 1 role in Bangalore, London, or Dubai, and you receive your first massive paycheck. The legacy advice, the advice peddled by obsolete financial advisors and terrified parents, is to save 20% of your salary in a high-yield saving account or traditional mutual fund and use the rest to upgrade your lifestyle. If you execute this advice in May 2026, you are mathematically guaranteeing your own wage slavery until the age of 65. This is a saving account funeral. Let us run the physics of the modern economy. Global fiat currency is structurally designed to debase real inflation. The cost of acquiring prime real estate, elite medical care, and sovereign asset is entirely decoupled from the official CPI number. If your bank is paying you a 4% yield on your saving and cost of Tier 1 asset is inflating by 12% annually, you are losing 8% of your purchasing power every single year. You are bleeding capital while standing perfectly still. Furthermore, traditional retirement vehicles like 401k or the standard provident fund are grounded into an obsolete assumption of a stable, linear 40-year career. The AI-driven labor market of 2026 is hyper-volatile. You cannot assume you will have a stable corporate salary for 4 decades. If you put your first paycheck into saving account, or you are providing cheap liquidity for the banks to lend to an apex operator, who will use your money to buy the exact asset you cannot afford? You are funding the machine that enslaves you. To break the matrix, you must reject the concept of saving. You must pivot to the concept of aggressive equity acquisition. The 22-year-old fresher who retires by 30 does not save money. They convert their biological labor into sovereign, digital, and physical equity. Phase 2. The fresher as a venture capitalist. The urgent strategy. To achieve an 8-year retirement timeline, you must undergo a violent psychological transition. You must stop viewing yourself as an employee and start operating as a sovereign venture capitalist. When the amateur receive their first salary of AED 25,000 or INR 1.5 lakh, they instantly initiate a lifestyle inflation. They lease a luxury car, they rent a premium apartment in the city center. They absorb the massive monthly liability. The apex operator of 2026 fresher treats their entry-level salary as a raw seed capital. You must deploy the venture capital protocol on your own life. You act as a general partner, the GP of your own biological fund. For the first 36 months of your career, you artificially engineer an environment of extreme, ruthless austerity. You live exactly as you did when you were a university student. You eliminate all vanity expense, all depreciating liability, and all lifestyle inflation. You compress your living expenses to consume only 30% of your net income. You treat the remaining 70% not as a disposable income, but as a heavy artillery for equity acquisition. Why is this an urgent strategy? Because the compound leverage of capital deployment at age 22 is mathematically explosive. Compared to a capital deployed at age 35, you are front-loading your risk curve. When you inject a 70% of a Tier 1 tech salary directly into high-yield asymmetrical market over highly concentrated 36-month window, you escape the gravitational pull of a middle class. You build a capital base that generates enough autonomous velocity to completely replace your biological labor value within 7 years. You're not saving for a rainy day, you're aggressively buying your own freedom from the corporate grid. Phase 3, the 2026 regulatory arbitrage, bypassing the gatekeeper. Historically, executing a venture capital strategy as a 22-year-old retail employee was illegal. The legacy financial system enforced accredited investor laws. These laws explicitly banned the working class from investing in high-growth private equity, reserving the most lucrative asymmetrical wealth generation mechanism exclusively for millennials and institutional funds. The working class was forced to buy public stocks only after institutional investors have already extracted the 10,000% exponential growth. But the 2026 has introduced a massive, unprecedented regulatory arbitrage window, recognizing the collapse of traditional pension viability, progressive financial jurisdiction, spearheaded by digital-first regulators in the UAE's DIFC and specialized retail syndication laws in emerging markets have fundamentally rewritten the code. They have introduced a decentralized retail syndication. The DRS protocol allows freshers to legally pool their entry-level capital into special purpose vehicles, the SPVs, that bypass the traditional banking cartels. You no longer need $1 million to enter a private equity round. Through verified blockchain-audited syndicates, a 22-year-old software engineer in Bangalore can deploy $2,000 of their monthly salary directly into the seed round of a pre-IPO tech startup. The wealth gap is closing fast for those who understand how to exploit this specific regulatory window. You are no longer restricted to indexing the S&P 500 at a slow 8% growth rate. You can directly access the private market where truly absolute alpha is generated. You have the legal framework to act like a Silicon Valley venture firm using nothing but your first-year corporate payroll. Phase 4, the neuromorphic tech thesis, the future-proof visionary. Now that we have a capital allocation strategy and the legal framework, we must define the target. Where do Apex 2026 freshers deploy their pooled entry-level salary to guarantee a retirement exit by age 30? They are entirely ignoring the standard consumer app, generic software, and legacy crypto. They are deploying an aggressive capital into neuromorphic chip startup. We must execute a deep structural analysis of a global computing market to understand this thesis. For the last 4 years, the artificial intelligence booms were entirely powered by traditional GPUs, the graphic processing units, manufactured by legacy giant. But traditional GPUs have hit a catastrophic thermodynamic wall. They require a massive, unsustainable amount of electricity. They generate lethal amount of heat. The global AI compute grid is currently constrained not by software, but by the physical limit of a power generation. The future-proof visionary understand that the next $1 trillion wealth transfer belongs to the hardware that solves this exact thermodynamic crisis. Enter Neuromorphic Engineering. Neuromorphic chips do not process information linearly like a standard CPU. They are physically engineered to mimic the neural architecture of a biological human brain. They utilize spiking neural networks that only consume power when a specific node is activated. The mathematical result is staggering. A neuromorphic chip can process complex AI logic using fraction of a milliwatt of power, order of magnitude more efficiently than the best CPU on the market. They do not require massive cooling towers. They can run advanced AI logic on the edge without a cloud connection. This is the ultimate asymmetrical bet. The smartest 2026 freshers are utilizing their DRS syndicates to inject their salaries directly into a Series A and Series B round of a specialized neuromorphic hardware startup located in hardware's hub across Taiwan, India, and the UAE. They are not investing in the AI software. They are acquiring the foundational equity in the physical silicon that will power the next 50 years of human civilization. When these neuromorphic startups scales and inevitably execute the massive M&A merger and acquisition exit to the legacy tech giant, the equity multiplier is not 10x, it is 100x. This is how you secure a decade of compound interest in a single perfectly timed transaction. You turn your entry-level income into a legacy by owning the absolute bottleneck of global computation. Phase 5, the algorithmic exit, retiring at 30. We have diagnosed the saving account trap. We have mapped the venture capital psychology. We have decoded the 2026 regulatory syndicate. And we have established the neuromorphic investment thesis. The final phase is a mathematical execution of your labor market exit. You must deploy the algorithmic retirement. Retiring at 30 does not mean sitting on a beach doing nothing. In the context of the apex operator, retirement is defined as an absolute sovereign financial independence. It means your biological labor is no longer required to sustain your capital baseline. You work because you choose to, not because you are forced to. Here is an exact timeline of the exit. Year 1 to 3, the accumulation phase. You secure your high-paying entry-level role. You deploy the extreme austerity protocol. You live on a 30% of your income. You funnel 70% of your net liquidity into decentralized syndicates, building a diversified private equity portfolio heavily weighing neuromorphic hardware and critical physical infrastructure. You are absorbing maximum risk because your age is your absolute shield. Year 4 to 6, the compound phase. You maintain your corporate role to protect your daily cash flow, but your capital is now working harder than you are. The neuromorphic startup you funded in year 1 are hitting their exponential scaling curve. The private equity valuation of your portfolio are compounding. You do not liquidate. You hold the line. You utilize your corporate salary to continue acquiring equity in secondary market. Year 7 to 8, the liquidity event. The regulatory arbitrage window matures, the hardware startup execute their IPOs or acquired by a tier 1 conglomerate. Your syndicated equity is unlocked. A 22-year-old who aggressively deploy AED 15,000 a month into a perfectly selected 10x asymmetrical venture pool over 3 years does not exit with a modest retirement fund. They exit with a multi-million dirham sovereign war chest. At age 30, you liquidate a calculated percentage of a high-growth venture equity and transition the capital into a stable, high-yield, zero-capital digital asset, such as owning the interactive dashboard architecture or the B2B SaaS platform we discussed in previous sessions. You engineer a permanent workforce exit. You resign from your corporate role, you hand back your access badge, you are exactly 30-year-old. Your peers are just starting to panic about their mid-level management reviews. They are heavily in debt. trapped in depreciating mortgages and praying their 4% saving account will outpace the inflation. You are standing on a balcony in Dubai or a private compound in Bangalore, commanding a sovereign capital matrix that generates infinite autonomous liquidity. Look closely at the first paycheck hitting your bank account this month. Is that money going to finance your weekend lifestyle, or is it going to finance your permanent freedom? The 2026 global economy will relentlessly crush anyone who relies on a biological salary to survive. You must break the programming. Stop saving pennies, reject the lifestyle inflation, embrace the austerity. Pool your capital, attack the neuromorphic hardware market, and turn your first salary into an ultimate sovereign equity. Process the data, execute the strategy, and I'll see you at the top.